If you're looking for the best ETF to invest in 2025 for long-term wealth, I'm going to show you exactly what I'm holding, and more importantly, why I'm holding them. I'll give you not just one but three best ETF to invest in 2025 for long-term wealth, and I'll walk you through the specific metrics, the strategy behind each one, and how they work together to build a portfolio that compounds year after year without the drama. Here's the deal. I'm giving you the three names right now: VOO, JEPQ, and QQQM. But like I've said in multiple other videos, I hope you're not someone who just sits there waiting for the names and then goes out and buys them blindly, or who just hears them and says, "Okay, cool. Those sound like good ETFs," without understanding why they're the three best ETFs for long-term growth and stability. This video is going to give you the specific metrics and reasoning for each one of these ETFs. Watch the tools I use and the why behind my reasoning for picking these as the best ETF to invest in 2025 for long-term portfolios so you can do the same and find great names for yourself. Remember, it's so much more valuable for me not just to give you the fish, but to teach you how to fish so you'll never go hungry. When you see my reasoning and the research behind this video, you'll see exactly why these are among the best ETFs for long-term investing. All of this will be very important, especially as we navigate market volatility over the next 5 years. I am Andrew. I'm building $1 million portfolio, and I'm breaking down every move, every strategy, and every lesson along the way so you can do the same. Before I get started, what ETFs are you buying and holding for the long haul? Comment down below with the reasons so others can learn and maybe look into those names for themselves. Let me start with a hard truth. Most investors think the fastest way to get rich is by finding the next Tesla or Nvidia. They chase hype, burn cash on speculation, and wonder why their accounts look like a graveyard of bad decisions. Here's what the data shows. Between 85% and 90% of active managers, professionals with teams, models, and unlimited resources, underperform the market over time. These are people who do this for a living, and they still can't beat a simple index. Warren Buffett proved this point in the most public way possible. He bet $1 million that a boring S&P 500 index fund would beat hedge funds over 10 years. And he was right. Quiet compounding crushed complicated strategies that charged high fees and delivered less. That's the real lesson here. ETFs remove emotion. They spread risk across hundreds of companies, charge pennies in fees, and keep you invested when fear tells you to sell. That's why they win over decades. That's why when people ask me about the best ETF to invest in 2025 for long-term wealth, I always point them toward funds that prioritize consistency over speculation. Stock picking is entertainment that drains capital for most investors. ETFs are how you build wealth with consistency. Own the market, and stop trying to outguess it. So let's break down the three ETFs I believe are the absolute best ETFs for long-term investing, and why each one belongs in a portfolio built to last. If there's one ETF every investor should own, it's VOO, the Vanguard S&P 500 ETF. When people ask me for the single best ETF to invest in 2025 for long-term stability and growth, this is where I start. VOO tracks the S&P 500, meaning you instantly own 505 of the biggest companies in America. Apple, Microsoft, Nvidia, Amazon, Berkshire Hathaway, all in one ticker. No chasing, no guessing, no emotional decisions. The numbers. 12-month return, 17.06%. Expense ratio, 0.03%. That expense ratio is critical. On a $100,000 position, you're paying only $30 per year in fees. Compare that to active managers charging 1% or more. That's over $1,000 annually on the same amount. Over 20 or 30 years, those fee differences compound into six-figure losses for actively managed funds. You'll never beat the market with VOO, because it is the market. But you also won't blow up your account trying to time earnings reports or ride meme stocks. It compounds quietly, year after year, through bull markets and bear markets. VOO is the bedrock. It's boring. It's predictable. And boring plus predictable is exactly what wins in compounding. If you want a foundation that's nearly impossible to mess up, VOO is one of the three best ETFs for long-term wealth you can hold. Most investors never build real wealth because they ignore income. They focus only on price appreciation and miss out on one of the most powerful forces in long-term investing: cash flow that reinvests itself. That's where JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF, changes the game. This is one of the best ETFs for long-term investing if you want both growth exposure and monthly income. Here's how JEPQ works. JEPQ tracks the NASDAQ 100 but sells covered calls on those holdings to generate premium income. The result? You get exposure to the biggest growth names, Apple, Microsoft, Amazon, Nvidia, plus one of the highest yields in the market. The performance: 12-month total return, 16.45%. Rolling dividend yield, 11.52%, paid monthly. Expense ratio, 0.35%. That's real monthly cash flow. On a $100,000 position, you're receiving roughly $11,520 per year in dividends, paid out every single month. That income can be reinvested to buy more shares, accelerating your compounding, or it can supplement other income sources. Here's the catch. Because of its high yield, JEPQ is best held in a retirement account like an IRA or Roth IRA if possible. That way, the income is tax-sheltered, maximizing compounding. In a taxable account, you'll owe taxes on those monthly distributions, which can eat into returns. VOO compounds steadily through price appreciation. JEPQ pays you while you wait. Together, they balance growth and income. One of the smartest combinations you can hold when searching for the best ETF to invest in 2025 for long-term portfolios. If you want cash flow without losing tech exposure, JEPQ belongs in a long-term portfolio. It's one of the best ETFs for long-term investors who understand the power of income reinvestment. Now, before I show you the third ETF, which is pure growth, I want to let you know I have a surprise ETF waiting for you at the end of this video. It's one that most people overlook, but it's been quietly delivering exceptional returns with less volatility than you'd expect. Stick around after I cover the third ETF, and I'll show you exactly why it belongs in a long-term portfolio. But first, let's talk about pure growth. If VOO is the bedrock and JEPQ is the income engine, then QQQM is pure growth. This is one of the three best ETFs for long-term investors who want concentrated exposure to innovation and technology. QQQM tracks the NASDAQ 100, stacked with the biggest tech titans: Apple, Microsoft, Nvidia, Amazon, Google, and Meta. You're buying the innovation economy in one ticker. These are the companies driving AI, cloud computing, digital infrastructure, and the next wave of technological transformation. The performance: 12-month total return, 21.95%. Dividend yield, 0.55%. Expense ratio, 0.15%. Here's something most people miss. QQQM is cheaper than the more popular QQQ, yet it holds the exact same companies. Same exposure, lower cost. That small difference in expense ratio compounds significantly over decades. On a $100,000 position, you're saving about $50 per year compared to QQQ. Doesn't sound like much, but over 30 years at a 10% annual return, that difference grows to over $8,000 in your favor. QQQM is concentrated in technology. When tech sells off, like we saw in early 2022 or during other market corrections, QQQM drops more than a broad index like VOO. That's the trade-off. Higher growth potential comes with higher volatility. So QQQM plays a different role than JEPQ. Where JEPQ trades some upside for income, QQQM keeps all the upside and provides no cushion. That makes it a pure growth complement to VOO. If you want to tilt your portfolio toward innovation and megatrends, QQQM is your lever. It's one of the best ETFs for long-term investing if you believe technology will continue driving market returns over the next decade. Now, remember I mentioned a surprise ETF earlier? Here it is. SCHG, the Schwab U.S. Large Cap Growth ETF. SCHG is the underrated growth ETF that does the heavy lifting quietly. While QQQM gets most of the attention, SCHG has been right there with it. And in some ways, it's even better. SCHG holds large-cap growth names, Nvidia, Apple, Microsoft, Amazon. But instead of focusing on just the top 100 like QQQM, it spreads across 200-plus growth leaders. That broader scope makes it less top-heavy and less concentrated than QQQM. The performance: 12-month total return, 21.87%. Dividend yield, 0.37%. Expense ratio, 0.04%. That expense ratio is tiny. On $100,000 invested, you're paying only $40 per year in fees, roughly a quarter of QQQM's cost. And the compounding impact of lower fees is massive over decades. If you're comparing the best ETFs for long-term growth, fee differences like this matter enormously. Think of it this way. QQQM is a sniper rifle. Concentrated exposure to the NASDAQ 100. Full upside, full downside. SCHD is a wide net, still growth-focused, but more diversified and cost-efficient. Together, they balance each other. QQQM gives you the sharp tech edge. SCHD gives you diversification and smoother growth. If you want tech-heavy growth with less concentration risk, SCHD belongs beside QQQM. Hold both and you get growth exposure that's powerful, diversified, and cost-efficient. That's why SCHD is one of the 3 best ETFs for long-term investors who want growth without putting all their chips on just 100 companies. Let me tie this all together, because understanding how these ETFs complement each other is what separates good investors from great ones. When you hold all 4, VOO, JEPQ, QQQM, and SCHG, you're covering every base. VOO gives you broad market exposure with 505 companies across all sectors. It's your stability anchor. JEPQ gives you monthly cash flow while keeping you invested in high-growth tech. It's your income engine. QQQM gives you concentrated exposure to the top 100 tech names driving innovation. It's your growth accelerator. SCHG gives you diversified large-cap growth at an ultra-low cost. It's your balanced growth layer. Together, they cover stability, cash flow, and innovation, the exact combination that builds wealth that lasts. Here's what most investors miss. They want to pick one winner and go all in. But that's not how long-term wealth is built. Long-term wealth is built by owning multiple best ETFs for long-term investing that work together through different market cycles. When growth is roaring, QQQM and SCHG deliver. When markets turn volatile, VOO stabilizes. When you need income, JEPQ pays you every single month. That's the genius of a diversified ETF portfolio. People usually ask themselves, but what if the market crashes? What if tech sells off? What if rates go higher? Here's the thing. Of course there will be volatility. There always is. But when you hold the best ETF to invest in 2025 for long-term wealth, you're not trying to time the market. You're trying to own the market. Look at the data. The S&P 500 has gone through the dot-com crash, the financial crisis, the COVID crash, multiple corrections, recessions, and bear markets. And yet, over every 10-year period, it has delivered positive returns. That's what long-term investing is about, surviving the downturns and benefiting from the recoveries. When you own VOO, JEPQ, QQQM, and SCHG, you're not betting on one company or one sector. You're betting on the fact that innovation, productivity, and human progress will continue, and that companies will continue finding ways to grow earnings over time. That's why these are the 4 best ETFs for long-term portfolios. They're built to withstand volatility and keep compounding through it. That's it for this video. Hope you liked it, and in case mentioning SCHG reminded you of SCHD, I do have a comparison video of investing $100,000 in both. Consider watching that video. I'll see you there.